The growth of subnational spending of public services and capital investments in Kenya and all over the world is mostly attributed to the health, education, and basic infrastructure sectors. Where we are today, it may not yet pose a major threat to our macroeconomic stability, but given the existence of 48 governments, each with its own priorities, the likelihood of this being futuristic problem is not only anticipated, it should be managed to ensure that the national debt management framework is anchored on a strong principle. Ladies and gentlemen, as county governments, our growing concern is that we must first and foremost manage our resources before we even attempt to look for any external funding. However, we must ensure county preparedness for the expiry of the 2-year sovereign guarantee proviso by the National Treasury. Currently, and in line with the provision of the Public Finance Management Act, the Cabinet Secretary in charge of the National Treasury may guarantee a loan only for capital purposes, and all the provision of IBEC must be observed in implementing the above. The Act further gives the county assemblies powers to determine the limit of total borrowing and indeed gives provision for bridging cash shortfalls. This is working in the interim but may not continue to serve the interests of the counties. Ladies and gentlemen, it is therefore gives me great satisfaction to see that the National Treasury has embarked on a path to address this issue before the expiry of the guarantee period. It is our wish to see this process being done consultatively so that the input of all stakeholders is appreciated and is factored in. As county governments, and in having been in place for the past 1.5 years, we are indeed in a good position to determine which areas should be prioritized for loan approvals. Ladies and gentlemen, as we speak today, most of our borrowing is project finance, which continues to be viewed as a more expensive and risk way of financing due to its limited recourse. We must be prepared for a scenario where bankability may be more elusive, especially for county governments. This has even greater impact, not only on project loans, but on all international lending operations. Risk mitigation is an aspect of borrowing that must be well explored and mitigated. For county governments, lenders will become even more demanding and seek to minimize their own credit risks more by either allocating more risks to the county governments. This will, however, enable the public sector to further interrogate their projects proposals and ensure we get the how-to right from the beginning if we are to fulfill our mandate.